next guest says getting Europe to approve a bigger EFSF is a key for investors. Let's find out why. We're joined by Daniel Morris, global strategist at JPMorgan Asset Management. Good to see you, Daniel. Why are you so sure and convinced that that is the key to this?
Well, sure and convinced that it's the key in terms of what has to happen. I think investors for sure have realized for quite a while that you needed a bigger write-down for Greece. 50 to 60% of the numbers we're talking now. So if you allow that, what does that mean for banks? How do you deal with that situation? So this has been clear. The problem was that the politicians didn't seem to acknowledge it.
Have they got it yet?
I think so, and I think that's the reason for a real change, in my opinion, in the perspective, in the outlook, that it's improved, that you finally have this acknowledgement from the politicians that we have to do this. For now, we have to work out the details, who's going to pay and how. It's certainly very key, but I think that first step is the biggest one. And
OK, so let's have a lolook at in a little bit. Like, how big should the EFSF be? And exactly, it is a key question we can't ignore. Where is that money going to come from?
On one hand, you could say it is big enough as it is if you look at what the actual liabilities are likely to be. But we're in a market where you want the bazooka, you want to have 300% guarantees that there's not going to be any problems. So that's the need for some way of leveraging the fund. So the latest idea of having the governments guarantee the debt, which seems perfectly reasonable, as opposed to the ECB. Again, the details may be less important than the fact that you get to a bigger number.
So what does this mean for investors, and what does it mean as far as your asset allocation is concerned?
Well, we think the way we viewed it over the last couple months is that risk assets as a whole look very good from a valuation basis. If we look at the outlook for global growth, assuming a reasonable solution to the Eurozone, it looked attractive, but we always were very aware of the risk that things don't go well. I think that risk has fallen, but it's still there.
Do you think the rally that we've seen over the past 40 days has really been a bit overdone?
Oh, not at all. Markets? No, I think there's still potential. I mean, if you took the multiple on the market from July, when earnings expectations were higher, you apply that multiple to lower earnings expectations today, you've still got at least another 10 to 15% potential. Not saying that that's going to happen. So I think there's room for just the rally off of the removal of the risk aversion to go quite a bit further.
What about fixed income? You've got some concerns over gilts, I understand.
Well, I think if you have to think about what's going to happen or what the implications are of QE2 for the UK, and it seems that to some degree the Bank of England has decided that if you have to choose between inflation and growth, sometimes it's a one or the other. We need to go for growth. We'll have to worry about inflation a little bit later. So if inflation is going to be higher than people expect for longer, maybe than investors expect, then the implications for gilts are that ultimately yields have to go back up.
And what about US Treasuries?
At least you don't have the same worries about inflation. I don't think it's, QE2 has ended there, so Operation Twist doesn't have the same effect on the money supply. So I think from that angle, it's probably not as worried.
And commodity energy companies, how are they shaping up in this new regime that we've got going, maybe?
Well, I think for oil, the fact that oil has fallen so much is one reason we feel better about the economy, especially the U.S. economy. But now, as people then consequently think global growth isn't going to be as weak as they thought, no double dip anywhere, oil prices will reflect that. But I don't think for any of the commodity prices we're going to get back to the levels we saw a couple of months ago really quickly.
And you're convinced there's no double dip, despite what the bond markets might be saying about the possibility. It's a 60% chance.
Sure, no, I think that's way overdone. The numbers you've seen come out of the U.S. for sure are much stronger than people expected, and I think we're well away from that.
Daniel Morris from JPMorgan Asset Management. Great to talk to you. Thanks very much indeed for joining us today.